So let's talk about how to build a dividend portfolio in 2026 from scratch.
Oh boy.
Yes, this should be a lot of fun. So let's start from the beginning, which would be, what do you want your portfolio to do? So what are, like, when you're going to think about building a portfolio, what's the most important thing to know?
If you're building a dividend portfolio, you're going to start with yield, which is your payout. But then from there, you can decide, do you want that payout to be maximized? Do you want the most income that you possibly can get? Or you may be in a scenario where you want some growth. So you're willing to take on a little bit lower income. Or maybe you're somewhere in the middle and you don't really know. So you just kind of want the blended. So there's kind of three options really that you can go. But I think before you really get started, you've got to identify what type of income you want.
You need a plan. You got to know what you need. Let's go back up one more step. You got to know what you need first.
I'm 40. We're just going to figure that part out later. No.
I would say
what do
that's
you need?
A different show.
Yes, that is a different show.
You are right.
Resist. I was thinking about it the whole time.
Yeah. My mind actually went completely beyond that because I'm thinking about just building a dividend portfolio. But the truth of the matter is, before you do any of this, you have to understand your shortfall.
Yeah.
That being a given. And when we're thinking about, all the things that you just stated, I think to a client or to an investor, the first thing that we can't ever get rid of is the fact that we just want to grow. So we are talking specifically about a dividend portfolio today and generating positive income from a portfolio. And we want that portfolio to grow a lot. But there are some nuances to dividend investing that they're almost counterintuitive to what we actually want. Because what happens if you have a dividend stock and it's $100 and it's paying a 5% yield? $5 for every $100 you own, right? What happens when that stock goes from 100 to 200? We're all happy because our investment doubled. Is there any negative to that?
Yeah, now instead of $5, it's $2.50.
Well, it's still $5 a share.
Well, but it's 2.5 yield. Yeah, you're not able to buy as many shares.
Well, you have twice as much.
Yeah.
So what happens when you rebalance? What happens to that stock? So if you have 5 stocks in your portfolio and the one stock's at 100 and the others are at whatever, or now it's at 200, when you rebalance, what actually takes place?
Should be able to take some of that growth.
You're going to end up selling that stock. So that $5 a share, which is now 2.5% because the stock doubled, you're actually going to be skimming some of those shares out off the top, and you're going to be buying into a stock that went the other direction.
Right.
So you're compounding your yield on the opportunity one, and you're taking from the one that grew. So there's a funky dynamic that happens here, and we're all like, we want our stocks to all go up. Well, actually, we don't want them to all go up.
No.
Because if they all go up, you're never going to find that good opportunity when things go down. And isn't that, I feel like this is a truthism of real life. At the times when we're on top of the mountain, I don't know anybody that look back and is like, yeah, that's when I grew the most. Most of the time when you're on the top of the mountain, it's like, yeah, that felt the best. But when I got the furthest ahead psychologically, spiritually, emotionally, whatever, it was always when I was in the gutter, the
you got a little
the valley.
over there. You're absolutely right, though.
But the reality is that's what happens with I'm going to relate
I like that.
reality to life and relating to dividends
Yeah.
and to stocks, because when they're just in the gutter, you can jump almost decade ahead.
Right.
Because like the pandemic, when things went crazy, they went on massive sale for no reason. I mean, legitimate reason.
Yeah. It wasn't an
specific reason to that company.
Yeah. It wasn't like the company did
the world
anything
shut down.
wrong.
Right.
Yeah.
Right.
Just no one needed gas.
Yeah.
Right.
Just things went crazy.
Yep.
And those stocks went on 40% sales in 30 days.
Right.
And then you were able to
Flash
make, you could jump ahead so far because you had this opportunity. So the reason why I'm bringing this up is we're not discounting this fact. This is a very important fact, but we're not really talking about that either. We're talking about how to build a dividend portfolio. What's your objective? Do you want that income to be super steady?
Mm-hmm.
Do you want that income to be growing every year? Or do you really just want growth in your portfolio with income inclusive? So, because there are 3 kind of models. I want a lot of steady, I want some growth, or I want a little combination of both. I want
Yep.
steady income with growing income. Or there's those investors out there that go, I want all of it.
All of it.
Yeah.
Give me it all.
Everything.
I want growth in my portfolio, I want growth in my
now.
income,
Right
I want
now.
steady income, and I don't ever want to lose.
And I heard you about that stock that maybe doesn't perform as well. I don't want that one.
And I don't want
That's right. That's
And
right.
that's the one that's going to get
Which one
us
was that?
4 decades ahead.
Yeah.
You know.
Yeah.
We can just be patient for a year. You might really want that one back in there.
All right.
Yeah.
So what are the pillars? Let's talk about the pillars of dividend portfolio.
Yeah, so the first one, you've got those foundational growers. Those are your aristocrats
Yep.
that have been paying and increasing their dividend for 25 years plus. You know, there's even some that are over 50 years, which is
And this is just
insane.
one pillar.
This is one,
Because
yeah.
there's people that hear aristocrat and like, oh, that's all I need to do. Go buy aristocrats. What is the danger of just buying aristocrats?
Well, sometimes, you know, they'll have a strong growth and a history of paying, but you may not see a ton of like actual market, like your
Appreciation.
principal appreciating. So if you're wanting to play that game of both, this might not be the group. Now there are some for
and
sure.
aristocrats typically have very low yields.
Right.
So when you
Yes.
see a really strong company that has a history and culture of paying their dividend and increasing their dividend, it's typically like 2%.
Right. Like a Coca-Cola, like they've got a very long history of paying. I mean, Coke and Pepsi are in this same thing. We'll throw some
We'll give
love
a
over
shout out
there.
to some Pepsi.
Yeah. So, but they both have this long history of paying. They're both aristocrats, but yet their yields are pretty low. And you don't see tons of market growth on those either, just because they're very mature.
They're
companies.
steady.
They're
Right.
steady.
They're going to be a
They're the-
bedrock, a
That's it.
foundation.
Yep.
All right.
The,
So we
the
got
oak tree.
What's
They're
that?
They're
The oak tree. That's good.
Yeah. And then we have income producers. So there's all kinds of stuff that would be here. One of the most foundational here would be an energy stock. So these are high producers of yield. You know, these are going to be that somewhere in the 4 to 6% range.
They're dropping a lot of fruit from those trees.
Lots and
Yes.
lots of consistent fruit and income. They're great. Then you have those opportunity seeds. All right. What is an opportunity? Like, what would that be? Not necessarily an example of a stock, but when we're saying you have foundation, these are aristocrats, you have the energy companies, infrastructure, the perishables, those types of companies that are producing stuff that we have to buy all the time.
Yep.
Those are your income producers. When we say opportunity, what are we talking about?
Right now, you're like looking really into the tech space because you've got a lot of these companies that were founded in like the 90s, early 2000s that, 50%, 70% growth every year is really hard to do on where they're at now. So in order to kind of keep the investor engaged, they've started implementing
They're
dividends.
sprinkling in those dividends.
and they're starting to pay those out, and they're getting a track record of multiple years of paying
It's
and
like
increasing.
Apple would be one.
Apple's one, Microsoft is one. Microsoft, if it hasn't yet, it's right at the cusp of becoming the aristocrat status, which is pretty fascinating.
Mhm.
But even Nvidia, I mean, it's like nothing, but they do pay a dividend.
Facebook came out a couple years
Meta
ago.
just came out. I bet it's not too long before Google and Alphabet
Amazon.
and Amazon do.
I think Tesla's way out, but I would say Amazon
Yeah.
probably within the next decade are going to
Yeah, they just
declare
keep
dividends.
because they're going to have all their infrastructure in place,
Yeah.
and then it's like, okay, now what? And they'll implement because they produce so much
money,
cash,
and they're going to come out.
Yeah.
Their dividend's going to be strong right out of the gate. I bet.
yeah. But it's those kind of less mature companies that are moving into maturity, and they're needing something to keep the investor.
And we're talking about
engaged.
some huge companies here, but some of these would be like smaller companies, that you wouldn't think of, like a real estate company, an up and coming, energy company or something like that nobody's really heard of,
Right.
or it could
a little
be
riskier to get in at the beginning.
I would say it just
From
doesn't
the
have the
dividend
following.
perspective. Yes.
Yeah, or
Yeah.
they've only been paying their dividend 5 or 7
Right.
years or something like that, where there's a lot of opportunity. There could be some volatility in there, or a
Right.
company that cut its dividend.
Right.
Where you're just like, hey, they just blew up their aristocrat status. They sold off some things in their company,
Yeah.
and they went down into the gutter. And you're like, whoa, there's some opportunity here.
Well,
right
and that's
now.
what's funny is like as we're doing our research on dividend payers, you're starting to see these mature companies, but they all slice their dividends in '08.
Mhm.
But that's a long time ago now.
You're right.
So they're starting to
add up.
kind of get
Getting
into
there.
this 10 to 15 year of paying a consistent dividend. So they're kind of the swells coming back on these other companies. So it's fun to see kind of the payer come back a little bit.
It's super fun. And those are the types of opportunities that you would want to add in. Now, percentage wise, from a foundation, those aristocrat type companies, they don't all have to be aristocrats. We're not saying aristocrats. I'm thinking around 50% of your portfolio, if you're building it from scratch, those high quality, the income producers, that'd probably be another 20 to 30% or so.
They're going to help you get your
40%.
yield up, right?
Correct.
Yeah.
And then the opportunity seeds, that's going to be that 10% or so. So you've got, of your 100% of your portfolio, the lion's share is probably going to end up being in that foundational, and I don't want to put aristocrat in there, but high quality, strong yield.
Very
income
critical.
Producers would be another healthy percent, almost the same balance of those two, with 10 to 20%, 10 to 15% of that opportunity.
That flyer.
Exactly. But that's all you really need to get that pop, right?
Correct. Yes.
You're comfortable with that.
You get a lot of pop from
you take
a few
one,
companies.
That's
right.
it. One or two. Because, and we'll get to this, I guess, kind of segue. Like, how many holdings should you really have? So if you're in this 15 to 30 stock range, well, that's 1 to 2 companies that you're on a flyer. Right. They take off in a given year and they can really.
So I would say if you're a really experienced researcher and you understand the dividend world well, 15 to 30. If you're a novice and you're just getting into this, I would say 30 to 50.
Go to 50. Yeah.
Okay.
Because you need to spread your risks. Now if you got 50, that's a 2% exposure per stock.
Yeah.
Because the less
One
you
or
know,
two
the more
misses doesn't hurt
dangerous.
you. Yeah.
The less, you have two or three big stocks in there that get crushed. Now you're gonna be panicked and going, I'm not too good at this.
Yeah.
Well, if I
Spread
throw
your
a
risk a little
sports
bit.
analogy in here, we always talk about a team, and you want somebody who can drop down a bunt. You want somebody who can hit a home run. But here's the other thing: when you're a kid, remember the t-ball team, and you had like 40 kids who came up to bat, but only the first 3 could hit. Maybe the first 5 could hit. You didn't get back to them forever, so you diluted those first 5 big hitters because you have 25 other people who've got to hit. Whereas the strong teams, as they get older, they don't have a whole lot of subs. They got one just in case somebody gets hurt, maybe a couple just in case, but they got their strong line up there because they believe in it and they know. But did that make any sense?
It does, but I didn't know that.
Oh, yeah.
I never played t-ball.
You didn't coach t-ball, and then as you weaned up, you got soccer family.
Yeah.
Well, even then, you don't want 20 people on the bench.
Typically, you only got 1 or 2 that are really pushing the ball up. Everybody else is just jogging
put them
around.
in the middle.
Yes.
If you have too many subs and you got to take out your goal scorer too often, they're out for 10 minutes. How can we put all the other kids around them in basket?
So is this a Nickyism?
It's got to
Might
be.
be. I always bring it back to sports.
Well, last thing I want to talk about is a few things to avoid.
Yeah.
First is chasing high yield. I think we get this question the most. We get, from some clients
It's a shiny thing. It's so hard
to check out this stock that's paying 12%.
Right.
Yeah, we did.
Why is it paying 12?
Turned it fast.
So chasing the high yield is a big one. Companies with falling earnings, there might be some really strong stocks. You look on Yahoo or wherever you're looking, seeking alpha, and you're just looking at their price and you're looking at their yield and you're not looking at their financials. That is the biggest danger. If you have a company that has a strong history, but currently their last year earnings were really bad, that's why it probably popped up in your chart because their yield is high. And now they're having a second year of pretty scary financials. You could find yourself in a very bad situation with a company that you just need to get rid of. What other ones? Payout ratios. Payout ratios, the percentage of revenue that's getting paid out to the dividend. I would want to make sure that, 60 to 80% once you start going above that, just understand why. If you have a payout ratio of 160% or 200%, that doesn't mean it's bad. They could be paying off debt. They could be using money to do all kinds of things that could have short-term pushed that payout ratio super high. So I wouldn't.
Could have had a share buyback or something. Yeah, anything. There's a lot.
Who knows? There's so many reasons.
You just better understand why.
Why?
Right.
Is it sustainable?
That's it. That's it. Because it could be shoring it up, the dividend, but other times it could be that, we're in trouble.
Well, their balance sheet's bad.
Yep.
And their debt's getting out of hand.
That's
all right,
right.
final takeaways.
No, this is so much fun. I would just say, be sure you understand what your goals are.
Right.
Take your time, be patient, and be sure you don't just pick 5. Spread out so that your yield especially if you're taking some chances. That way it doesn't crush your whole portfolio.
And then I would just say also make it manageable instead of don't make it 100 or 200.
Yeah.
Don't have too-
diluting
Don't
yourself,
over-dilute.
it's overwhelming again.
Right.
So keep it manageable, keep it simple.
That's right.
And I do think with dividends, it's being patient. And you referenced it earlier, but so many of our clients are people new to the dividends, whether you're a client or not. At the beginning, you got to give it a minute because otherwise you don't see the power until it starts to get going. And you start seeing that drip and the reinvesting and the rebalancing and the tough times and just seeing that when you're at the top of a mountain, somebody's actually, and you're at the bottom and you're just building, somebody might throw you that little thing and help you get up to that top, but you got to give them time.
That's it. Patience
But
is
patience with dividends especially is huge.
with all investing.
Let the
I feel
income
like.
help you through.
This is good. I love it. All right. So subscribe to the show. And if you haven't gotten our dividend starter kit, this is the perfect show for it.
That's right. That's what it's all
'cause
about.
We were talking about building your own portfolio. Put in the comments below dividend starter kit. We'll get a hold of you and get you that right away. All right. God bless.